we're hosting as part of the 2021 RedeConnect event, the no-cost, no-carbon, COVID-compliant alternative to super return. The subject today is the state of the secondaries market, and we have 45 minutes to cover what's a big subject in what has been a dynamic period for a strategy which has already been undergoing strong growth and rapid evolution prior to the onset of COVID. If you have any questions, please submit using the Q&A function, and we will do what we can to cover them in the time available. By way of brief introduction, I'm Magnus Goodlad, and I lead the transactions team at Rede, which is the firm's principal interface with the secondaries market. I'm very fortunate to have as my guest Nik Morandi, who is extremely well placed to speak on this subject. Nik has a distinguished career over 15 years in the secondaries market in senior roles at Pantheon, CPPIB, and since late last year with Strategic Partners, part of the Blackstone group, where he leads the European private equity team. For the few, if any, who do not know them well, Strategic Partners is one of the largest secondaries platforms operating across private equity, infrastructure, and real assets. Nik, you've recently made a transition from one of the largest private market asset owners and investors in the world to the largest private market asset manager. Clearly, part of the rationale for this was withdrawal symptoms from fundraising and wider LP engagement. But how would you characterize any differences in investment approach of the large asset owners in the context of their secondaries private equity programs?
Magnus, thank you for that very generous introduction. Quite a lot to unpack in that sort of seemingly benign question. So I'll do my best to cover it. There's a lot to unearth in terms of what it takes, frankly, to run a successful secondaries program, how different groups define success, and also how, in a certain sense, they define secondaries. There are some fairly significant differences in investment approach. I'd say that they are very closely correlated with two fundamental elements. Firstly, the structure of the firms, and as a result of that, the competitive advantages that they own. And secondly, which is largely a consequence of the first point, the people, the team composition that you have, and to a certain extent how those people are also incentivized. In terms of large asset owners, and I'll sort of try to make this sort of somewhat generic in terms of the application. Organizational structure, most often secondaries sit typically within a much larger private equity program, and beyond that within a much larger alternatives program that often includes private credit and real assets. The secondaries is generally speaking not the biggest of those various strands. Funds, primaries, and latterly, sort of more recently, directs have historically more recently been kind of the key drivers. They've attracted more capital. Funds is where the program started. Directs is where some of these programs aspire to be. But as we know, capital can be very significant. These groups operate through quasi-perpetual capital with no fixed term. So what are the competitive advantages? Super deep relationships with a number of managers, typically a relatively, if I can call it, narrow range of GPs towards the larger and mega end, but certainly lots of capital with those core manager relationships. Some GPs, however, and this is one of the advantages that some of these groups do have on the secondary side, is some managers that are not within that primary stable, seeing secondaries as almost the entry point into the firm, which can be really attractive and valuable to the secondary teams. I'd say the ability to be a little less focused on multiple as a buyer, because you're implicitly continually recycling and recommitting capital, would be one difference. In terms of the teams, really lean in absolute terms, and even more relative to AUM. I mean, it's amazing what can be done with a relatively small number of individuals. And on the incentive side, and I'll come to a moment in terms of what the impact of this is on strategy, but incentives generally a little bit more tied to IRR rather than multiple, because the public benchmarks are IRR equivalents, and because of that ability to recycle that I mentioned earlier, MOIC and multiple becomes, frankly, a little bit less important. In terms of strategy, the lean teams result sometimes in partially outsourcing the secondary exposure to third parties. But that aside, in terms of what's done in-house, ruthlessly efficient, you've got to be ruthlessly targeted because of the team size. That points you then in the direction of large deals and concentrated deals. There's less value placed on diversification. also because of the huge denominator that you are operating off the back of. You're not sort of responsible for a 2 billion or even a $5-10 billion fund. Your denominator may be 100 billion in private equity alone. So you just care less about concentration for understandable reasons. On the other hand, I'd say the margin a little bit less able to compete on diversified deals. You don't necessarily have the relationships that span the spectrum in terms of stage and also in terms of strategy. Velocity of capital back at the margin, probably also a little bit less important in terms of demonstrating the cash back and the de-risking really quickly. The other point, and I'll move on to the privates in a second, very clear lines of demarcation, again, typically speaking, between where the secondaries team operates and it's licensed to operate and where it stops, and where, to the extent there is a direct business, where the direct business picks up. And that certainly has some consequences for the ability to look at the some of the concentrated GP-led deals, which I'm sure we'll come on to later. But mandate flexibility is certainly there. More tolerant, I'd say, of lower absolute returning deals, but good risk-adjusted returning deals, as long as those transactions are also distinct from what perhaps the private credit team is doing within these institutions. So pluses and minuses. In terms of the private market, the larger asset managers, of course, of which we're one, organizationally, I mean, secondaries do tend to be very large, very successful businesses in their own right. And certainly over the course of the last few years, one of the fastest growing businesses. So there is a degree of prioritization there and support in terms of resources, both human and otherwise. Very deep networks of relationships that are built up over, in some cases, decades. And not to make this about us, but one data point: we have 1,400 GP relationships. We're in over 4,100 funds, and that's just been built up over many years. So that, and because those relationships span buyout, growth, venture, infra, real estate, and credit. I mean, it's not just for us, but for others too. You can front up to a different type of deal, and you're solving a different type of problem for a vendor. If you can speak to all of those asset classes in a single transaction, I'd say a really pragmatic approach generally to GP-leds versus direct. It's not an equation that's based on a finite pool of capital you've got. If you've got the performance and you've got the support from your LP base, you'll go and raise the fund or the additional capital for GP-led. So less clear and sort of philosophically in terms of what you can and can't do. The competitive advantages are a result of that. Very wide funnel of opportunities across more GPs and strategies. You've got more touch points. You've got LPs. You're more relevant, I'd say, for many managers. You can deal with that multi-asset class complexity I mentioned. On the team size, large generally, fully dedicated almost always, rather than operating across sort of multiple strategies. In terms of then the investment strategy for the privates as distinct from the end stage investors, setting aside specialization, because that is becoming the norm in secondaries as much as it is in direct P now. And the agents, I mean, you and others are obviously acutely aware of what the differences are, even amongst some of the larger groups. But in generic terms, I'd say that velocity of capital still acutely important, short duration, really attractive. It's what LPs want. It's what they're paying for. Portfolio management and diversification, more important. Every fund and every vehicle has to stand on its own 2 feet. And I'd say the other difference is at the margin, perhaps even more than just at the margin, to be honest, a more consistent investment pace. A, you've got the fund and the time horizon of the fund, but B, because you've got the wider funnel and you can do arguably a lot of more, perhaps more deals, smaller, bigger, more strategies, rather than the slightly lumpier sort of investment approach of the other asset managers, that leads to a bit more dollar cost averaging over the course of the life of the fund. And that can be a good thing, it could be a bad thing, but I think it is a difference in terms of how these different types of institutions do approach secondaries and invest.
Great.
I'll stop there.
So it's a very, very interesting response. And just staying with the market participants for a moment, as the market grows, it's inevitably attracting new entrants, and we're seeing announcements all the time on that. If we roll forward 5 years, how would you see the respective secondary market shares of the current cohort of specialist managers, new entrants, and asset owners?
So I might need to distinguish between traditional LP secondaries, GP-leds, and then probably a third bucket, preferred equity, special situations. On the traditional LP secondary side of things, I think the barriers to entry for new entrants are genuinely really high. I mean, it's not impossible to get into this industry, and some have done it, but without question, the exception rather than the norm. So I think the market shares of the established players, they may ebb and flow. Some may raise a larger fund, one cycle relative to another. But overall, I mean, it wouldn't surprise me if the main players today were broadly the same in 5 years' time. Frankly, as was the case 5 years ago relative to today. Yep, some movement, but I don't think it's been dramatic. The caveats to that would be if we start to see more perpetual vehicles being raised, retail, evergreen, closed-end, self-funding vehicles that have a particular hunger for secondaries, because secondaries allow you to put the money into the ground immediately, and you get the capital back and the distributions that allow you then to keep sort of scaling up and building out the program. We might see new entrants there for traditional LP secondaries. Another caveat, of course, is acquisitions or consolidation in the market, but that's perhaps slicing the pie just differently, or musical chairs rather than genuine new entrants. Yeah. And I'd say the other potentially more significant caveat would be, I mean, secondaries is now, let's call it 100 billion plus market. Those are the expectations of many of us for this year at a minimum. If the market gets to become, which in my opinion it will, let's call it a $400-500 billion market in a few years' time, it's difficult. It's much more difficult to ignore that, even for the end stage asset owners who may be active in primaries and in co and in direct, but haven't fully committed to secondaries. I think it becomes perhaps a bit more difficult to ignore the secondary landscape once you start to get to $500 billion of annual volume. So I think that is an important caveat. But then the volumes would be there. On GP-leds, I think it is a bit different, a bit more nuanced. I mean, secondaries managers will grow in this area. The established funds will have success. I think on the final asset owner side, the relevance here has been frankly lower recently. So their overall relevance to secondaries will shrink just proportionally unless they're more willing to embrace this market. I mean, I think we will see new entrants, however, either through acquisition or building teams on a de novo basis. What could they get to? I mean, I can pluck a number out of the air. I can say maybe they'll get to be a quarter of the market. Could they be a third of the market? I mean, it's perfectly possible. I think it is a bit circular though, because if there is credible, dedicated, professional new capital entering the GP-led space, I think there'll be an effect of then further growing the supply side, because if as a GP you're looking at the buy side and you've got just more credible capital there that's able to operate at scale, I think it's going to generate more deal flow. So I think it is in a sense a little bit self-fulfilling, but I think there will be new entrants. The challenge they have is the credibility, the access to the relationships. If I were advising a new entrant, I mean, why would I do that? I suppose, but if I were, I'd say, if you can operate at the really large end, you can distinguish yourself by underwriting super large tickets. You can probably also distinguish yourself with some of the mid-market or lower mid-market managers. If you are a very large direct player that is moving into GP-leds, there may be some sort of intangible benefit to a small cap or a lower mid-market manager and being part of a much wider network, a bigger ecosystem, and that could be a sort of a selling point that new entrants could bring to bear. On the third bucket, just to make sure I don't forget that, the special sits, pref, structured, NAV financing, I think it's a little easier to be a participant in that market. So perhaps more new entrants there. It's more transactional in nature. You're more of a capital provider, a little bit less based on relationships with the GP. So I think it's easy for new entrants. There's frankly also a bit more overlap with existing lines of business. If you're a new entrant and you have a direct lending product and you have lots of touch points with GPs, you have those relationships, but secondly, it's not a huge leap of imagination then to start to offer a whole fund financing solution rather than at a single portfolio company level. So perhaps some new entrants there, NAV, pref, certainly a few in GP-leds. On the LP side, I think it's pretty tough.
Yeah, that makes sense. You've touched on GP-led transactions, which is the core of the Rede advisory business in this part of the market, and clearly the breadth and application of GP-led transactions has grown and broadened significantly in recent years. And although commentators differ on the exact level, there's consensus that 2020 was also a record year in terms of GP-led transactions as a percentage of the overall secondary market volume. And in parallel, there have been a range of adjacent capital structures and investment trends which have evolved and also extend hold periods for GPs, and in many cases provide liquidity options to investors. Do you see long duration funds and Spanx and cross-fund trades as having a material impact on the single asset GP-led volumes over time?
I mean, personally, on the Spanx side, I don't think so. I mean, I'm not a Spanx specialist by any stretch of the imagination. I mean, my view on it is if an asset is suitable for a SPAC, it obviously presupposes it means it's ready for kind of public consumption, it's ready for the public markets, and I can't really see that competing with GP-led. It's a very different type of solution. Long duration funds, they're looking for assets that have a much longer time horizon than most single asset GP-led secondaries, and they're looking for candidates that can justify that slightly lower cost of capital. I mean, it's possible that there will eventually be buyers of some of the single asset continuation fund deals, but only of a very small subset of those companies, I'd imagine. I mean, some of them, but perhaps more as a ultimate buyer than as a genuine competitor to many of them, or to many of the GP-led deals. In terms of, you asked about cross-fund deals as well, Magnus, is that right?
I did, yeah, absolutely, and come on to follow up on that.
Sure. I mean, in terms of cross-fund deals, I also doubt it, although it is a bit, maybe a bit more qualified, my answer there. First of all, I'll say LPs don't love these deals without third-party price verification. If the market knows that a cross-fund deal is possible, so if a deal is launched by a GP, but a cross-fund deal is a genuine possibility, I mean, I do think that has the potential to lessen the competitive tension for that asset. So that's something that you just got to bear in mind. I think the two could live together. I mean, a continuation fund transaction could certainly act as that price validation mechanism for a cross-fund deal. I think that is possible. What cross-fund deals, of course, don't have is the roll option. That's one of the beauties of continuation funds, is that you have that choice as an LP in the vast majority of cases to decide whether to stay invested or not. I mean, it's worth acknowledging that the vast majority of LPs that do a cross-fund deal, they go into that with fairness, with transparency, with sort of probity, absolutely the forefront of their minds. I don't doubt that for a second. In some cases, it will be the best option for LPs in both funds, but it is quite hard it's harder to demonstrate that. And as we know, there's a lot of alignment with the GP in a single fund continuation structure. It's just that much more concentrated. The carry rollover, the crystallization, and the dollars therefore that go, or the euros that go into the new deal, I think it's order of magnitude bigger in terms of alignment. What I can see happening is, and there's been some examples of this already, is a manager, rather than putting the entirety of an asset into a and I'm talking about single asset continuation fund deals here primarily, rather than putting the entirety of that one asset into a continuation fund structure, sell a minority or a majority stake to another GP. That sets the price. That's the third party mechanism, which the secondary market could itself provide, but nonetheless, that's sort of step one of the process. And then the residual, whether minority or majority stake, the GP continues to own via a continuation fund. So, I mean, that mechanism has occurred generally because there are other reasons for why the current owner, the current GP, wants to bring on board another GP into that deal. Maybe they're looking to expand geographically, and they want a partner that perhaps has a bigger presence in that particular region, or it's product repositioning that another GP has done before. So there tend to be other reasons for why that is the path that's taken, but there are ways in which continuation fund deals can live alongside some of these other deal structures.
Well, one of the market growth opportunities which Adam Turtle identified in the long Rede plenary session yesterday was for minority investors providing pricing validation for those kind of transactions you're describing. But as you've highlighted, there are central valuation challenges, and it'd be interesting to get your perspective on whether you can see any development or variant of fairness opinions which have enjoyed at best mixed success and affection in the eyes of LPs as alternatives to auction processes.
Personally, it's hard to see. I mean, this may be overly blunt, but I think fairness opinions aren't worth that much to most buyers. I mean, unless the provider of a fairness opinion is prepared to put money behind the deal, it inevitably and can only be a theoretical assessment. I see it almost as akin to a broker report for a public company. I mean, if you're thinking about buying that public company, you'll read the report. You may even learn from it. But I don't think it's legitimate to criticize the research analyst if the 12-month price target in a broker report turns out to be inaccurate. I mean, so equally, I don't think it's legitimate to be basing your purchase decision or your valuation on a single fund deal based on what the fairness opinion says. I mean, it's not designed for that purpose. Only you as a buyer can possibly decide what that asset is worth to you. I think though that fairness opinions are nonetheless useful in more of a legal procedural sense for GPs and for LPACs and LPs. I think it can be helpful to know that the manager has gone through due process. I don't think a fairness opinion is required to demonstrate that process has been undertaken. I mean, just appointing a qualified, experienced advisor like Rede would accomplish that, I think, for the vast majority. But fairness opinions, I think, have a role to play there, but just as one component alongside many others of, let's call it the equivalent of a vendor due diligence pack for both buyers and existing LPs in the fund. So I think helpful in that sense. A variant of them, it's not obvious to me what that variant would be. I mean, I could be missing something, but I sort of yet to see them develop into something that I think that would make them much more relevant in the process and in the price discovery mechanism for these deals.
Yeah, and we'd agree with that assessment. Turning to a facet of what was a feature of early GP-led transactions, and it's still ongoing in some context, but it's the concept of a hard or soft staple of primary capital commitments alongside secondary transactions. Do you think those kinds of staple transactions will become increasingly rare in the market?
I think so, and I think they have already become less common, hard staples, but still relevant in certain specific instances. There is a continuum in staples, lots of flavors, lots of varieties of them. There are LP tender processes that include a prescriptive staple request on the part of the GP or the advisor on behalf of the GP. There are tenders without a formal staple ask. GP-leds, of course, with staples. Staples on one-off LP transfers rather than these sort of orchestrated tender processes where those staples are enforced by the GP as a precondition to allow the transfer, and then staples on one-off LP transfers, but whether they are willingly offered by the buyer as a way of sort of enhancing the relationship. I'm probably missing some, but I mean, those are, I think, 5 I've mentioned. Tenders with staples are becoming a lot less common, largely because tenders themselves are becoming a lot less common. I mean, we don't like them as buyers because take-up is genuinely pretty unpredictable. So you can do a lot of work and then not know what the ultimate outcome is. I mean, we will participate in tenders, certainly where we've already done all the pricing on the fund and the net incremental cost of refreshing the diligence is close to zero. But I think they are less common these days. GP-leds with formal staple requests have also become a little less common for lead buyers, but here it is more nuanced than that. We are seeing staples as a feature of deals that subsequently become syndicated. Overall, I see that the whole sort of staple discussion and topic is fairly quality dependent. The highest quality GPs, arguably don't need them. High quality GPs that do incorporate a staple, and there are examples of GP-leds where this does happen, the staple is not particularly controversial because many of the buyers, frankly, are quite happy adding some primary money, or some of them may want to become an LP that aren't an LP. I think it's fair to say that sometimes a staple can even be accretive to MOIC on the deal. One of the better ways, I think, to manage the staple request, and it becomes a bit of a hybrid hard soft staple component. If you're running a GP-led, maybe let the price set without the staple. It's a clean price discovery, price maximization process. It's a level playing field for all potential buyers. If all the buyers come out in the same place, then I'd say, by all means, decide the winners based on the other bells and whistles that may form part of the offer, which could include the staple amount. I mean, I think it's pretty unlikely, to be honest, that everyone will be exactly equal level pegging. But the other way of doing it, which I think is more elegant and has happened, and I suspect will continue to happen, is set the price, go through that process of price discovery, let the deal be anchored by the lead investors through that process. That could be one, it could be two, it could be multiple. And then as the manager, if you have the ability to carve out a portion of that deal and then run a accelerated book build sell down after that, potentially to a slightly different investor base, maybe slightly more primary oriented investor base that wants more unfunded primary capital to be put to work and wants that relationship with the manager. I think that is absolutely a mechanism that is reasonably well trodden, I'd say.
Agreed.
Yeah,
I absolutely agree. And as the secondary markets develop to become more sophisticated, the conflict and process management is in general improved from early days, although there's still a number of transactions taking place which we hear referenced where LPs are on the spectrum between uneasy and unhappy. Are there any common errors which you see from which GPs and advisors listening today can learn?
I'm not going to tell an advisor, Magnus, with your experience, what they should do, but I might frame it slightly differently then. I might, in terms of what's important, apart from hiring a good advisor, present company obviously included, what would I say based on personal experience? Spend the time on prep. I mean, most obviously, spend the time on prep and be very clear on the rationale as a GP of why the deal makes sense. Put yourself in the shoes of your LPs and see things from their point of view. For instance, will the deal crystallize carry? And if it does, that's not a problem per se. I think what is a problem is if that's not addressed and sort of preempted early, and the narrative and the control of the sort of the dialogue starts to shift away from the manager. So bringing a core group of LPs, potentially a couple on the LPAC, some of the larger, more influential LPs potentially, bring them inside the tent to get that buy-in, to get these questions addressed. And there may not be any potentially contentious issues to address. Either way, I think bringing them inside the tent a little earlier is just good protocol. Don't jam your investors, give them as much time as possible, obviously not always feasible. Certainly don't launch until you're ready. I mean, there have been examples that I won't name, but I can point to where the deal was launched semi-publicly, before all of these issues had been ironed out, but also before some of the key LPAC members were even aware that this was on the cards. And as an investor, particularly an important one, I mean, that's the last thing you want, is to hear about the deal via a third party rather than from
GP themselves.
Yeah. And then I'd say understand your LP base as best you can in terms of rollers and sellers, and therefore the potential likely deal size here, and therefore the underwrite requirement, because then that will give you the confidence, whether as the manager or the advisor, as you're speaking to the buy side, to articulate, pretty clearly, these are what we think are the bookends in terms of potential appetite, sell versus roll appetite, and therefore this is the underwrite requirement. This is how large the deal is. I think that could be really actually sounds very simple, but really kind of powerful for a process. And then these are just variations on a theme. If there's unfunded there, an unfunded follow-on requirement, which of course will take the deal a little bit away from a totally pure status quo option, explaining really clearly what's that for. It's been pre-identified for X, Y, and Z. I'd say this happens in the vast majority of cases already, but being very clear about why that unfunded exists and what it's needed for as part of the whole thesis for why the GP-led deal is necessary in the first place. Yeah. Nothing, Magnus, I'm sure that you haven't mentioned.
No, but it's very helpful for those on the call to hear it articulated from people on the receiving end, as well as people who are sitting next to them in certain circumstances, advisors. I'd just like to turn to another element of process, which has been subject to comment over the last year, which is on the role of the LPAC in processes, particularly for circumstances where they're more controversial. Can you see LPACs looking to take a step back and contract out of formal roles and opining on proposed GP-led fund restructurings and taking a more sort of consultative role with the decisions and interface occurring more directly between the GPs and LPs?
I'd actually be interested in your opinion after this. Don't mean to turn the tables, but my view on this is, I think the LPAC role is fairly limited already, and I don't sort of say that offhand. I think it's pretty clear what the LPAC role is, mainly around waiving the GP conflict. Individually and collectively, LPAC members, of course, shouldn't be making investment decisions on behalf of others. That's not the role, not our role when we're on LPACs. It's not what the expectation should be. Is it possible that the conflict waiver point could become a whole LP vote, which would of course require the consequential changes in the language in the LPAs? It's possible, but I personally doubt it. I don't think GPs would want to do it. I'm not a GP in that sense, but it's more onerous. There's more risk of a leak. As a manager, I would prefer the unanimity, if a process is well run, the unanimity that I am likely to obtain through an LPAC vote. I think that is adequate. And so, in a sense, to turn the question on its head, why is there a requirement for a more broad-based approval mechanism than the one via the LPAC? I think that an LPAC should be comfortable waiving those conflict issues if the deal structure is appropriate, i.e. there's an option, not an obligation to participate, and there's a quality advisor running the deal. So as long as you can check the box on some basic procedural good practice, I'm not sure what the additional value add is in extending that decision beyond the LPAC. Could we see general partners eventually appointing an advisor that is accessible just for the LPs in the fund as a resource to aggregate LP Q&A, to summarize diligence? It's possible, and you've got the main quote unquote main advisor acting as the interface between the GP and the buy side. Possibly. Again, I don't think that's terribly likely either, but I don't know whether you've got a different view, Magnus.
No, I think our view is that the GPs should be running processes, hopefully with, as you said, sensible advisors on board, which don't put LPACs in situations where they feel uncomfortable, and that the conflict waiver role is one that they feel is clear cut, and that potential issues have been addressed, and that the reasons why they seek representation on the LPAC in the first place remain valid and don't get displaced by having to exercise that judgment, and that there is a And again, you touched on it in one of your earlier responses, but in terms of the LP engagement, that the LPs themselves have adequate time to make a decision and feel like that their interests are being respected in running a process, so that there isn't any sense of, well, how has this got to us without the LPAC having represented our interests in an additional way.
Yeah, that makes sense.
They're not popular today, but can you see any role for legislating for fund restructurings and continuation fund opportunities in LPAs at inception in future?
Maybe. I mean, it is actually a possibility. Could give GPs more confidence if that type of transaction has been signposted. But again, is it actually needed? I mean, I suppose back to the discussion we've just been having around the LPAT role. I mean, if a GP-led makes sense and it's well and appropriately run, I mean, there's nothing in today's LPAs or in the vast majority of today's LPAs that would prevent the GP from getting one done. It's perhaps more relevant for whole fund restructurings and all those deals that don't have a genuine status quo option. So could the GP reserve the right to launch a GP-led from year, parentheses X, whatever that X is, year 8, 7, 9. And as an LP, you sign up to that possibility at the very start of the fund when you sign your subdocs. Probably not a particularly easy message to deliver from GPs to their LPs. I mean, unless you position it more positively, as the general partner, you will explore all available liquidity options by year X on a best effort basis and standard for offering, and some sort of orchestrated exit mechanism. Sure, I mean, that language may begin to find its way into LPAs. But I think that the language and the process that exist already can legislate for the majority of deals, and certainly the deals that should get done can get done. So it's again not 100% clear to me what the additional advantage of doing that would be, other than some value in signposting to an LP in the fund that, okay, well, maybe my illiquidity premium here could be a little less than it should be, but there's already a super liquid secondaries market. So again, I'm not really sure what additional value it brings, but
yeah, I mean, our view is that it often do more harm than good, because it has a sense of this is premeditated and it's not being judged on the merits of the individual situation at the time, and all the potential is the GP seeking to legislate for, as it were, continuing their economics. It's better, as you said, to rely on the judgment at the time. I mean, it's a different point, but it is again something that you touched on earlier. Our view is that one area that GPs should be considering in new LPAs, and with hopefully their lawyers advising them on this, is more permissive structures on fund level financings, where we see very distributed outcomes in terms of what GPs are able to do in terms of introducing leverage at the fund level, which in our experience can both significantly reduce cost and risk in terms of credit solutions. And if you've got very restrictive LPAs, it can significantly increase both the cost and ease of implementation of a solution. So I mean, I agree with your conclusion on saying this isn't something that people should be looking to legislate for more, but that is an area where we can see opportunity for development. And
on that, I genuinely wholeheartedly agree, Magnus. I mean, I should have mentioned that, because there has been too much rigidity there in how LPAs have been drafted, and what's categorized and defined as debt funding has handcuffed, I'd say, some GPs in a way that isn't in the best interests of LPs in those funds. So I think that we will see change, and personally, I think rightly so. It will be beneficial. Yeah.
There's one question that we're frequently asked, which again, it would be very interesting to get your perspective on the other side of the transaction, is whether you can see any standardization and harmonization of fee structures across continuation funds and single assets in particular, or whether this will inevitably remain bespoke and transaction specific.
I've got a pretty clear view on this one, which is the latter. I think bespoke and transaction specific. The fees that become payable in GP-leds or a part of the structure in GP-leds are a function of a number of things. The GP track record, obviously, the performance of the asset that is the subject of, or assets that are the subject of the GP-led performance to date, the expected performance from here, the duration of that, expected duration of that investment, and the balance between IRR and MOIC then has implications on the hurdles that exist in the waterfall, and lastly, the competitive tension in the process. I'd say, unlike in an LPA, where clearly within the private equity industry there is a fair amount of standardization in terms of the 2 and 20 model. I mean, it's not complete there either, by any means. But in a GP-led, as opposed to having anywhere between 20 and let's call it 200 LPs in a fund, you might have 1 or 2 deal leads. It becomes a much more balanced negotiation between GP and investors, but also highly deal specific. So I don't think standardization is in the best interests of anyone, frankly. It would result in some deals not getting done that ought to get done in the interests of investors, and other deals that would get done, but based on the wrong ratchet, the wrong mechanism, and therefore the wrong price ultimately being paid. And there'd be winners and losers, but it just wouldn't be the right structure. Having said all of that, there are already some, let's call it, emerging standards and benchmarks. Tiers in the waterfall, almost always, I mean, there are some exceptions, but almost always there's tiering. Not uncommon for IRR and MOIC-based tiers, but very asset dependent. Carry very rarely starts at 20%. I mean, I can probably count on one hand the situations where that's occurred, at least in the more recent past, in the last few years, and certainly the quality end. Almost always an 8% first threshold, so which is of course equivalent to what we see in normal LPA. So yeah, there are some anchor points that exist, but within the waterfall, there's an almost infinite number of permutations that exist, and I think that is likely continue. I mean, it's so dependent on all those elements that I mentioned earlier, and also how the GP themselves thinks about the performance of the asset and the confidence levels, and how much they are prepared to weight upside versus downside protection for the incoming investors. So there's just a lot of elements there that is, I think, very, very difficult to synthesize and distill down to a single solution.
Well, that wasn't scripted, but as an advisor, that's the answer I was hoping you would give. I think we've covered a lot of ground in a relatively short period, and we've been very fortunate to benefit from your customary insight and candor. So on behalf of us all at Rede and our RedeConnect audience today, please can I give you very many thanks, and thanks to our audience for joining us today.
Thanks, Magnus. Yeah, it's been great. Thanks, everyone.